What was your thinking when you heard the reports?
Well, exactly what you just said. I mean, you have to leave the Fed independent. Since the year 1913, 112 years ago, the Fed's always been independent. And the markets will not like lack of that. You have to have a line in the sand, and you can never cross that line. The Fed needs to be vigilant also with respect to inflation. If the Fed's not independent, who knows, will they bring rates down to which could be inflationary. Bond market will not like that. And so while the Fed will control the front end Fed funds and bring that down to whatever rate you want to bring it down to, the long end will not respond well if we believe, and we all believe, that the Fed is no longer independent. So I believe that Poly Market's probably right, 25% probability that Trump will remove him. It's a low probability event relative to your base case. And I believe that he will not remove him because it's too much risk with respect to markets, and what he wants is lower funding costs. But in the same breath, I also know that rates are just simply too high. At 4.5% Fed funds rate, the ECB has rates at 2%, but a 4.5% Fed funds rate and inflation running at 2.5% CPI, PPI, and PCE, and no trace at all that tariffs really are impacting higher core good prices, because we've seen April, May, and June. We haven't seen it flow through yet, and so we have 3 months of that. And so we're seeing it at Marathon in the exporters absorbing it, the importers absorbing it, and very little actually being passed through. So I believe it's not hugely inflationary, and we can't wait forever because GDP slowed from over 2% to 1.5% this year. Inflation's come down, and so with inflation at 2.5, GDP at 1.5, Fed funds should be 3%, not 4.5%. It's way too high, and I believe rates should be lower, but the Fed needs to be independent, full stop, and the Fed needs to be vigilant with respect to inflation.
And you're not the only one saying that. Jamie Dimon also said Fed independence is absolutely critical. I want to stay with Jamie Dimon for a moment, because during the JP Morgan earnings call, he made a comment saying that private credit has hit a peak when he was asked about whether JP Morgan might want to buy a private credit firm. I know that you have strong opinions on this.
Very strong opinions. I love Jamie Dimon. We all love Jamie Dimon. He does a great job. But look, at the end of the day, Jamie's talking his book. Of course he wouldn't like to see as much capital being raised in private credit funds. In fact, he'd like to see a lot less by talking that game, so that way he can get back in the game and be a leader in private credit. And look, the banks are our partners. We have a great relationship with Webster Bank. They reported today, great earnings. But with Webster Bank and Marathon together, we're originating and doing more and more deals, not less deals. Now, here's the big takeaway, though. Is private equity, Scarlett, Romaine, going to be smaller or bigger 10 years from now? We all know private equity is going to be a lot bigger. If private equity is going to be a lot bigger, then direct lending is going to be a lot bigger. So we know it hasn't peaked, it's going to get a lot bigger. Number one. Number two, and this is really important, asset-based lending. We've been doing it at Marathon. This is our 5th vintage, and we've had extraordinary results. $30 billion of asset-based lending that we've done, but that's in its infancy of private credit relative to where it will be, and it will be as big as direct lending in the next 5 to 7 years. And then you have opportunistic credit strategies that are capital solutions that can also help private equity and companies. So when you look at it, the private credit markets are growing at 20% a year. I believe it grows to 10 to 15 trillion in a decade. But it's not peaked. Nowhere close.
And here's the thing, though. I mean, but just to that point, and I'm glad you brought up those numbers, because, and not to discount Jamie Dimon, but I think what he says publicly and what's going on behind the scenes isn't always the same. And we've seen a lot of these big banks already sort of dabbling in private credit, in private loans. There was a story on the Bloomberg terminal today about how a lot more of these big banks are buying and selling private loans, kind of in a more informal capacity, but the idea that they're starting to make this more formal. And I do wonder if you think that the banks will finally have that sort of moment where they realize they can't keep poo-pooing this. They can't just sit on the sidelines, that they have to be an active participant.
I think there will be an active participant, but I think the markets, the public credit markets globally are around 12 trillion. The private credit markets globally are around 4 trillion. As markets converge, in a decade from now, as the economies grow and you have more debt, I think the public credit market will grow to about 15 trillion. I think the private credit market will grow to 15 trillion. So I think banks will have a big say in this, but banks want to finance not the riskier deals that might be associated with LBO transactions and opportunistic credit deals and some of the ABL deals we're involved in, but they'll finance our debt and make a loan on our loans. And that's a very good place for them to play. Second thing, as we have the democratization of the wealth channels, and we develop that, you might want to have some secondary market activity in debt to allow for liquidity within some of these listed products. And so I like to see the banks develop, actually, some of the secondary markets, which they're thinking about developing today. I think that would be a healthy development.
I'm glad you brought up the wealth channel, because this seems to be the next big evolution for private capital overall, particularly with credit and equity. Today, Elizabeth Warren, the senator from Massachusetts, raised some issues about this democratization of the private credit space and the idea of whether it was potentially heaping too much risk on a level of consumer investor that maybe isn't as informed. And I am curious as to what you think about that whether we are maybe creating a situation where people who don't know what they're buying are going to end up buying.
So, do you think institutions and very wealthy individuals should be the only ones that benefit from the private markets? I can talk about the private credit markets, which have been generating an 11-12% net return with half the volatility of the equity market, when the equity market only generates a 7% historical return. So it's a better risk-adjusted return, I believe, in the private markets than you get in the public markets. And to deny individuals the opportunity to make those investments, to me, is so much regulation that wrapped out around it that you're actually hurting who you're trying to help. And so what's important are the banks. So think about JP Morgan and Citi Wealth and Wells Fargo and Bank of America and all these banks that have wealth management divisions. They vet all the managers and they make the recommendations. Or the RIAs around this country are making the recommendations after doing the research. Or the big platforms like a Case or like an iCapital are doing all the research to vet what's appropriate, what's not appropriate. And so, yes, they probably need a little assistance, but they have it there. Now, these are the same individuals that are day trading options on, on equities.
That's a good point.
And so to say they can do that and not have a better risk return profile associated with the half of the volatility of the equity market with a better risk adjusted return, to me, doesn't make sense, doesn't add up.